Hello there. Welcome to EBM Info. We've got a question that we have here that we want to look at of cash flow statement. This is a question from a recent paper that is June 2023, and it's in question 4.3 on that question paper, question number 4. We want to go through this question and then we answer what is required. The question starts there from 4.3 and it reads, use the following information to draw up an estimated cash flow statement for the period January to April on answer sheet 2 attached. So there should be an answer sheet that is attached in your answer book that is specifically designed for this question. The next sentence saying, at the beginning of January, the business had a favorable bank balance of 3,500. So this balance, what it means is it is a favorable. So we are going to show it as a positive as the beginning balance. And we know that if it's a negative, if it was a negative balance, it was supposed to be shown as a negative, as in brackets. Brackets means it's a negative. So basically, brackets is a substitute sign for a negative sign. So that's what we have there. Then we go to the table that we are given. We are given the months, and then first the other column is representing estimated sale, the other one estimated purchases. So let's go down to see what the additional information has to say about information that needs to be transferred to the cash flow statement. That if you look at the first one, 4.3.1 reads the business bought a delivery vehicle in January and paid a 7,000 Rand deposit monthly, and then monthly installment thereafter 800 Rands for the next 2 years. Then we need to adjust for that one. And we also have other adjustments that are there. So we are going to move down the adjustments that we have there. And then if you go to the next page of this question, we are having a table that is there, which is showing average expenses per month. So these are the average expenses per month. So I think we can just add there to get the total sales per month. So it means these sales are applying to every month. These sales are applying to every month. So if you add them, that is 1,500 plus 1,100 plus 500 plus 170 plus 550. You are going to see that the total that you are going to get there is 3,820. So this is the total representing. Basically, these are total expenses that we have, total average expenses. So it means every month we are having this expense of 3,820. We're going to put that in the answer section. So you'd see that in the question we've got an opening balance that we need to start with. That's very important. Here we have a favorable balance that we have there. If you check there, a favorable balance of 3,500. So we're going to start with that balance. Let's go to the answer section now and put that first balance of 3,500. So this balance is going to start the year, the first month, which is January. So we are going to show it as a positive figure. You just write 3,500. So we leave it like this. It represents a positive, a favorable balance. If it was a negative, you are supposed to put some brackets. So you'd see that the next year in February, the balance that you're going to start with the year will be the closing balance in January. The balance at the end of January, we are going to take it as an opening for February. And the same applies to March and April. So the next item that we have there is cash sales. So we go back again to check what the question is saying about cash sales. If you come here, we have estimated sale, and these are the estimated sales. Then there's an explanation in terms of treatment of those estimated sales beneath that. So if you go to 4.3.2, there's an instruction there that 30% of all sales are on credit. And next sentence, debtors usually pay 30 days later. So here, what it means is initially for cash sales is going to be 100. Remember, this is for credit. So what it means is for total sales is equals to cash sales plus credit sales. That's what we have there. And then what it means, our total sales will be 100%. So it is equal to our cash sales is the one that is not given. We are given credit sales as 30%. So to find the figure for cash sales, you can just make cash sales the start of the formula there, and then it becomes cash sales. It becomes cash sales is equals to 100 minus 30, which is equal to 70%. So that's what we have in terms of that. So it means 70% is representing our cash sales. So the figures that we are given there are representing the total sales in the table that we have there. So if you go to the table now, we will multiply 70% by the figure that we are given there. So what does it mean? It means for January, you can come here and say for January here. So maybe you can add a column here and say this is now we want to calculate the percentage of cash sales. The proportion of cash sales for January. We can just maybe do this, and then for January we are saying 70%. Remember, as a decimal becomes 0.7, and then we multiply by, we have 6,000 there. We have 6,000 there, and then when we multiply that one, 0.7 times 6,000, we have 6,000 here. Let's try to calculate that one. We get 4,200 here. Then for February, again, we do the same, 0.7 times the figure for total sales is 4,000. So we multiply by 4,000. When you multiply that one, you are going to get for February now is 2,800. We apply the same thing to, we are now in March, I say 0.7 again times the total sales that we have in March, which is 4,500. And then if you multiply that one, you get 3,150. Then lastly, we have got April. We are saying 0.7 times 5,500. And then the figure that we are supposed to get there, you get 3,850. So these are the figures that we are just going to put there. For January, we put 4,200 until to April, 3,850. These are the figures that we have. In other words, we are saying this one is for January, this one February, this one March, this one April. So we are going there to put those figures in the cash flow statement. So if you come here, we have got the for cash sales, we have 4,200 here, 4,200. Then for February, we have got 2,800 according to the calculations that we made there. And then for March, we have got 3,150. For April, we have got 3,850. Right. So these are the figures that we have in terms of cash sales. And then obviously now we go to credit sales. But there is an instruction again that is there in terms of credit sales. Let's go back. You'll see that there we are also given an instruction in terms of credit sales. Let's see what they are saying about this credit sales. So we are still on 4.3.2. So we're going to go through that statement and try to see what is it saying. If you come to 4.3.2, it's saying 30% of sales are on credit. Debtors usually pay 30 days later. So there is the key area that is explaining that the debtors will pay 30 days later. So what it means is the credit sales for January will be paid in the money will be received in February. So that's what it means. 30 days later, which means 1 month after. So what we are going to do, we are going to calculate the credit sales for January, and the money is going to be received in February. So we are going to put it in, the money will put it on February. So it means in January there's nothing that is going to be received in terms of credit sales. So here now we can just say, let's try to see there. Right, we have this one. So now we are on credit sales. Credit sales. So what we are saying is the credit sales for January, the money is being received in February. Remember, this is a cash flow statement. When the money is going to be received, we will record it where the time it will be received. So the sales for January will be received in February. We record the sales, the revenue, or the receipt when it's actually received. Because the cash flow statement shows the cash movements, actual cash movements in and out of the business. So we need to record exactly at the point in time when we receive that cash. So we can just calculate the credit sales for January. Credit sales for January, these are the ones that are going to be received in February. So we can calculate them for February. The total sales for January is 6,000, but credit sales, we are told that 30%, which is 0.3. So we are in February. So this one's credit sales for January will be received in February. So we multiply by 6,000. So if you do that, you get 1,800. This is for February. Then for March, we are taking the total sales for February. So the proportion of credit sales is the one that is going to be received in March. So we take 4,000 and say 0.3 times 4,000. So if you calculate that one, you get 1,200. Then we go again to the next one, which is these ones for March are the ones that are going to be received in April. So we are saying again 0.3 times 4,500. And when you do that, you are going to get 1,350. So that's what we have. So in terms of allocating where we are going to receive this credit sales, this one is representing February, this one is representing March, and this one is representing April. So what we are receiving 1,800 in February, 1,200 in March, 1,350 in April. So we can go there in the other section and just put those figures. Go to the other section and put those figures. So we are here now on credit sales. Remember, we are saying in January we are receiving nothing because there are no other sales that you are told that we are the sales for December. We are supposed to have the sales for December to have something for credit sales being received in January. So we go to February. Remember, February we got 1,800. So we got 1,800 here. Then for March we got 1,200. So we got 1,200 here. And then for April we got 1,350. So 1,350. So that is what we have in terms of credit sales. We go on to other income now. We're now on the column of, on the row of other income. So we go back then to see what other income do we have in the question. We can go back there. So we are going to go down the question to see if we have got other income that are there. We check from 4.3.1, we check 4.3.2. Right, so we have 4.3.3 saying in March an old van will be sold for 2,000 cash. It means this is money that is going to be received, and it's going to be received in March. Very important. It's going to be received in March. So we are going to enter it as a receipt for other income in March 2000. So we're going to enter that one in March is 2000. So come here. So we go to March. We see other income. March is we have January, February, March is here. So we've got 2,000 here. It means here we have nothing. We have nothing here. But this one was received in March. But we can also check if you have got anything that is explaining about income being received. We go down in the computer report. So this one is actually money that is going out. So we skip it. Then we go to the last one. These are also expenses. We have got money being paid. So it means we have only other income in March. Then we go to the next one. In March, a new computer will be bought. The deposit will be 1,000. So it means this one will put it under the payment section. So we go there to see what's the next item that we have. Right. Then you go to total cash available now. So what we are supposed to do there? We're just supposed to add what we have on top there. But we are not adding for February, in March, April, because we we will do that when we find the opening balances here. So here we are just doing it for January only. We add 3,500 plus 4,200. Then we get 7,000. Here we are going to get 7,700. So we go down again. Now we are only concentrating on January. But if we have any adjustment that needs to be adjusted throughout, we can just make the adjustment. Then we see we have got monthly expenses. That is the next one, monthly expenses. So if you go back there, we've got the table that we are given there at the end of the question. This one, this is representing the monthly expenses, and we have got a fixed figure, a constant figure that is going to apply to all months that are there, 3,820. So we're going to enter that one in all months, 3,820. So we say here, we've got 3,820 is going to apply throughout. And then 3,820 also. So that's what we have in terms of that one. Then beneath that, we have got cash purchases. So we go there and try to see. Remember, we are given those balances at the beginning of the question. So we come here. We've got estimated purchases that are given 3,000, 2,000, 3,000, 4,000. Then we go beneath that now on additional information on other information, whether we've got anything to explaining about credit purchases or cash purchases, like what we did on sales. We are seeing there's nothing. So if we have nothing, it means the purchases that we are given are the cash purchases. So we're going to just take those figures, 3,000 for January, February, you take 2,000 as cash purchases, March, you take 3,000, and then April, you take 4,000. So we're going to enter those figures there. They represent cash purchases. So for cash purchases, we are seeing that we have 3,000 January, and then we have got 2,000, that is February, and we have 3,000 in March, and then we have got 4,000 in April. So that's what we have. So beneath that, now we check again what we have beneath that. We have got other expenses. Sorry, other payments. Sorry, other payments that are there. We check now in the question. Other payments. I think we can. If we go down to check if you've got other payments. Right. If you look at there is 4.3.4 there, which is saying let's try to see. We have got in March. Okay, 4.3.1. We've got something there. The business bought a delivery vehicle in January and paid a 7,000 deposit. So this man was paid in January. So in January, we are going to put a 7,000, which was paid there. And then next statement is saying monthly installments thereafter are 800 for the next 2 years. So it means 7,000 for January. Says next 2 years now, it's now February and March. We are going to pay 800. So 7,000 for January, then February and March to make 2 months will be 800. So we go there and put those figures. We go there to put those figures. We have 7,000 other payments there. That's where we are. So we are saying in January, we have 7,000. But we have 800 in February and also 800 in March for the next 2 months. Then we go again to check other instructions that we have there. Right. If you go there, I think on the last part, we have got in March, a new computer will be bought. The deposit will be 1,000. So in March, there's a 1,000 that is there. And monthly installment thereafter will be 500 for the next 2 months. So it means in March, we are paying 1,000, 1,000 in March. And then April, May will be 500, 500. But we don't have May, so we're just going to put April 500. And then March is 1,000. So we're going to go and put that one for those periods. So we are saying we are saying in March, that's where we have got 1,000. So January, February, March here, so we add another 1,000 here. And then here we have 500. Here we have 500. Is it 500? We can recheck there what amount we have. Right. This is, they are saying would be monthly installment thereafter would be 500 for the next two years. Sorry, for the next 2 years. So it's going to apply, and also yes for the next 2 years. Sorry, yes also for the next 2 years. So it means the 800 that is there is going to apply to the end of period that you are given there because it's for the next 2 years. Then the 500 will also apply to the end of the period that you are given, that is up to April. So we can just go and correct that one. Next 2 years. So if you come here, we now have a 1,000, then a 500 will come here. And remember, this 800 is also for the next 2 years. So it's going to apply this February, March, and then April up to 2 years. So here also you have 800. So we add the 2. So that's what we have. So here I think we can make an addition there. Try to see what we have. Having put this, I think we have enough on other payments. Total cash payments now we add from monthly payments up to other payments here. 3,820, 3,000 plus 7,000 here. Then remember here we are not putting totals, we're just putting in the first column. Total payments, if you add 3,820 plus 3,000 plus 7,000, you get 13,820. 13,820. So here is 13,820. That's what we have. And then at the end, we are supposed to have a closing balance that is there. A closing balance. So closing balance now, to get the closing balance, we are now saying closing balance, which is this one. We are now saying we have total cash available. Total cash available, then we subtract the total cash payments. Total cash payments. Then here, if you find that here in January, our total cash available, we check it there, we've got 7,700 is here. This is our total cash available. Then we subtract 13,820. So what we have there, we are now saying 7,700. Then we subtract 13,820 to get our closing balance. So if you do that, you are going to get a negative figure there. That is negative 6,120. So here we are going to put it in brackets so that is a negative balance 6,120. So this is the figure that we have. So this is the closing balance in January. So it's going to be an opening balance in February. So we go up there and put it as an opening balance. So we have now 6,120. 6,120, and we are putting it in brackets. So here we have in other sections we put the figures. So we are just coming here on total cash available now. We are saying this negative 6,120 plus 2,800 plus 1,800. Then we get a negative 1,520. Then we go down to check what we have after that. This is total cash available. So we are now going to payments. So on payments, we are just adding 3,820 plus 2,000 plus 800. Then for total cash payments, we get 6,000. 6,000 there. Let's try to see. Yes, we get 6,620. 6,620. That's what we have. Then we are now saying negative 1,520 minus 6,620. Remember, we are subtracting this one minus this one, but this one is already negative. So say negative 1,520 minus 6,620. Obviously this is going to be a negative again. And then there you are supposed to get a negative 8,140. So here now 8,140, and we show it in brackets, and it's going to be our opening balance again for the next month. That is March. So you go up there to put it there. So you've got a negative, which is in brackets 8,140. So for total cash receipts, we are saying negative 8,140 plus 3,150 plus 1,200 plus 2,000. And then the figure that you are getting there is negative 1,790. Negative 1,790, which is shown again in brackets. Then we go down. Now we want total payments that we have. So for total payments, we are saying 3,820 plus 3,000 plus 800 plus 1,000. Then the figure that we get there is 8,620. 8,620. 8,620. So that's what we have there. Then obviously now we are saying for the balance, we are saying closing balance, we are saying negative 1,790 that we have there minus 8,620. A bigger negative figure that you are going to see there. If you subtract there, you are going to get a negative 10,410. A negative 10,410. And this one also is going to be our opening balance for the last month, which is April. So we go up there. We go up there and we try to put that one as our opening balance. So we come here, we see that we have got a negative 10,410. So we have got a negative 10,410 here, such a big negative figure. Then we say negative for total receipts now, negative 10,410 plus 3,850 plus 1,350. So if you add that one, obviously the negative is going to go down to reduce a little bit. So we got negative 5,210 there. Negative 5,210. So we negative we have here. So here it's a, so we are putting it here negative 5,210. 210, although we are not supposed to show that that sign. You can just show brackets there. So we are saying this. Then we go to the lower part there where we are going to add the payments, of course. So for the payments now, we are saying 3,820. We add 4,000. We add 800. We add 500. So these brackets, we are just putting them to show that we have two figures that are there that we are supposed to add. It's not they are not there to subtract. We are not subtracting. Remember, this is adding to the total to get the total payment that we have. So we can just ignore this, or we can remove them so that they don't confuse us. Just put 800 plus 1,000, and then here also you remove them so that remember here we've got 8,500, 800 here, and we also have 500. 800 and 500, right? Then we are saying 2,820 plus 4,000 plus 800 plus 500. Then total payments now we get 9,120. Then obviously for the balance, closing balance, we are saying this negative 5,210. We subtract again 9,120. This is also going to be a bigger negative figure there that we are going to see as a closing balance. We go down. The figure that we get there now, if we calculate that one, this is going to be our final closing balance, which is negative 14,330. 14,330. So that is what we have, guys. That's where our cash flow is ending. So we can see that this business is in very, very, very serious cash crisis. In other words, it is in a liquidity crisis. We are seeing negative balances, as closing balances from the first month to the last month, which is a very, very bad liquidity position of a business. So that's why this cash flow statement is prepared. We want to see the cash position of the business. Remember, a cash flow statement is prepared according to the cash basis, according to the accounting principles, which is different from an income statement whereby we find profit in the income statement. We prepare the income statement according to what we call the accrual basis. So that's why we see a business making a lot of profits, but with a liquidity crisis. It's because they are making profits, but they don't have cash in the business. So they face cash problems. So that's why we have these cash flow statements. So the relevance is based on the reasons that we are trying to point out here. So thank you guys for listening. I will meet again in the next video. Those who haven't subscribed, please subscribe and share. We are still coming in the preparation of a final exam. Please subscribe, and thank you for watching. With that, I'm signing out.